Welcome back to the Daily Crypto Roundup. Today we've got a market that looks weak on the surface, but the real story is deeper than just red candles. We're going to break down why Bitcoin and the broader crypto market slipped after U.S Iran negotiations ended without a deal. Why XRP dropping to around $1.33 matters less as an XRP story and more as a sign of how fragile altcoin sentiment still is. Why SpaceX quietly holding more than $600 million in Bitcoin may actually be one of the most important conviction signals in the market right now. Why Senator Cynthia Lummis is warning that the Clarity Act could effectively miss its window and not get another real chance until 2030. And finally, why Trump-linked crypto tokens are back under pressure as senators dig into that April 25th gala and the whole question of whether meme coins are being used as a route to political access. So there is a lot to get into today, because on one side you've got macro fear hitting prices, and on the other side you've got politics, regulation, and long-term positioning all colliding at the same time. And before we get into it, this episode is brought to you by Kraken. If you want a serious crypto platform and you want to support the show at the same time, check out the Kraken link below. Now let's get into it, because the first thing people need to understand is that the weekend weakness was not some random technical wobble. Crypto fell because the market repriced geopolitical risk. After a day-long session in Pakistan, U.S. Vice President J.D. Vance said talks with Iran had ended without an agreement, and major cryptocurrencies all dropped in the aftermath. Other reporting around the talks said the negotiations lasted roughly 21 hours, failed over major disputes including Iran's nuclear program, and left markets worrying again about the stability of the ceasefire and the broader risk to energy markets. That matters for crypto because every time some people say Bitcoin is digital gold, a neutral safe haven, a hedge against chaos, and a system outside of politics. But in moments like this, the market still mostly treats it like a risk asset. Around 20% of global oil passes through the Strait of Hormuz. And when the market starts worrying that conflict could drag on or that the strait could remain disrupted, you get a repricing of inflation risk, energy risk, and general risk appetite. That is bad for highly volatile assets, and crypto still sits in that bucket in the eyes of a lot of traders. So yes, Bitcoin has a long-term hard money narrative, but in the short run, when geopolitical stress rises quickly, a lot of money still heads for the exits rather than into Bitcoin. That is the reality this market keeps having to confront. And that brings us neatly to XRP, because XRP dropping to around $1.33 is the kind of move that a lot of people online will immediately try to turn into some special Ripple-specific disaster. But that is not really what the evidence shows here. The reporting framed the move as a sharp intraday breakdown from roughly $1.36 to $1.33 on heavy volume, with aggressive selling and a weak bounce afterward. That is much more consistent with broad market de-risking and liquidation-style behavior than with some new XRP-specific fundamental bombshell. In other words, this was Bitcoin weakness pulling down majors, and XRP simply behaved like a high-beta large-cap altcoin. That distinction matters because if you misunderstand the move, you misunderstand what to watch next. If this were an XRP-only issue, you'd be looking for Ripple news, ETF rumors, legal headlines, or some direct token-specific catalyst. But if this is mostly a correlation move, then the real thing to watch is whether Bitcoin stabilizes and whether broader risk appetite returns. XRP right now is still acting like an amplifier. When Bitcoin firms up, XRP can move hard to the upside. But when Bitcoin weakens, XRP gets smacked faster because traders see it as a more speculative extension of the same risk trade. So I think the better way to describe XRP today is not broken, but dependent. Dependent on Bitcoin, dependent on sentiment, and dependent on whether traders want exposure to beta or want to get flat. Now, while all of that short-term fear is playing out, one of the more interesting stories in the market is actually about patience and conviction. SpaceX is still holding 8,285 Bitcoin worth about $603 million in Coinbase Prime custody, even though the company reportedly posted a nearly $5 billion loss for 2025 tied to XAI. And to me, that story matters because it cuts against the panic narrative. If a company associated with Elon Musk is dealing with a brutal headline loss elsewhere and still has not dumped its Bitcoin, that tells you something. It tells you that at least some sophisticated holders are separating near-term pressure from long-term treasury conviction. That does not mean SpaceX is about to become the new MicroStrategy, and it does not mean this single data point turns the whole market bullish overnight. But it does tell you that in an environment where retail gets shaken out by every headline, some large holders are still willing to sit on strategic Bitcoin reserves without flinching. And that becomes more interesting when you compare it to the broader market mood. Retail sees failed negotiations, red candles, oil risk, and altcoin weakness and starts talking like the sky is falling. Meanwhile, a major private company is still sitting on over $500 million in Bitcoin despite pressure elsewhere in its orbit. That is a real contrast between weak hands reacting to the present and stronger hands positioning for the longer-term outcome. The next big story is the one that probably matters most for the long-term structure of the U.S. crypto market, and that is the Clarity Act. Senator Cynthia Lummis warned Congress may be missing one of its best chances to pass the legislation, and that if lawmakers fail to move soon, the United States may not get another real shot until at least 2030. That is a huge statement, and it is important to understand it properly. She is not saying the bill has already been delayed until 2030. She is warning that if Congress misses this political window, the combination of midterms, shifting priorities, and legislative congestion could push meaningful market structure reform out for years. And frankly, that should bother anyone who wants crypto to mature in the United States. Because for all the talk about institutional adoption, ETFs, stablecoins, tokenization, and America-leading innovation, the market still needs clear rules. Lummis said this is the last chance to pass the Clarity Act until at least 2030. David Sachs urged the Senate Banking Committee and the full Senate to move now. Brian Armstrong said it is time for the bill to pass, and even SEC Chair Paul Atkins backed comprehensive market structure legislation. That is not a fringe coalition. That is a wide group of political, regulatory, and industry voices all saying the same thing. Move now, because the window may not stay open. The key snag is that Senate progress may depend on resolving disagreements around stablecoin yield before a markup hearing really gets moving. That point is important because it shows the blockage is not just broad anti-crypto sentiment. It is also about the specifics of how crypto products should function in law, who gets to offer yield, how consumer protections work, and how lawmakers want to draw lines between banking, securities, and digital asset regulation. So when people say, why can't they just pass crypto rules already? The answer is that these bills get stuck in the detail. And that detail matters, because once the framework is written, it will shape who wins, who loses, what products are allowed, and how quickly capital flows into the sector. Then we get to the Trump-linked token story, which is messy, political, and very revealing about a whole part of this market that still runs more on attention than substance. The Trump token is down about 90% from its January 2025 peak above $73, and World Liberty Financial's governance token WLFI fell to roughly 7 cents, a fresh all-time low. That is ugly enough on its own. But the bigger issue is that these declines are now being discussed alongside renewed scrutiny over an April 25th event for token holders. According to the reporting, Senators Elizabeth Warren, Richard Blumenthal, and Adam Schiff sent a letter to Bill Zanker seeking details about the event, arguing that organizers were effectively dangling access to President Trump while requiring attendees to hold Trump tokens. The Senate letter says attendance is limited to the top 297 Trump token holders, with special VIP access for the top 29 holders, and describes the conference as promising access to President Trump while appearing designed to boost his meme coin. And this is where the market lesson comes in. Tokens like this are not really being priced on utility, adoption, cash flow, or network growth. They are being priced on narrative, spectacle, attention, and perceived access. That can work on the way up, when hype is hot and people think proximity to power or celebrity gives the token extra value. But when scrutiny increases, that same model becomes fragile. Because then investors have to ask whether they are buying into a serious project or just paying to sit closer to the theater. And once that question starts getting asked in public by senators, the downside gets nastier. Because even the people who were there for the hype begin to realize the whole thing can unravel very quickly. So when you put all of today's stories together, the picture is actually very clear. In the short term, crypto is still vulnerable to macro shocks. Failed negotiations and renewed geopolitical uncertainty are enough to knock Bitcoin lower and drag majors like XRP down with it. In the medium term, the market is still split between weak hands reacting to every headline and stronger holders who are willing to sit on large Bitcoin positions through ugly periods, which is why the SpaceX story matters. And in the longer term, the biggest battle may not be price at all. It may be whether the United States can finally get serious market structure legislation over the line before the window closes, and whether the industry can separate real adoption from the kind of political meme coin circus that keeps handing critics easy ammunition. That is the state of the market right now. Bitcoin is still being tested as a macro asset. XRP is still acting like a sentiment amplifier. Big holders are still showing conviction where retail is showing nerves. Washington is still at risk of wasting a rare regulatory opening. And the Trump token saga is reminding everyone that not every crypto narrative deserves to survive just because it gets attention. Some of them are built on foundations that collapse the moment the spotlight changes direction. Drop your thoughts in the comments, smash like, follow, check out the Kraken link below if you want to support the show. And as always, we'll see you at the top.